Hey there, this is Josh Rogers in Tennessee, Nashville, Tennessee. I wanted to explain to you what bankers look at when they talk about debt to income ratio. So, debt to income ratio, or what we call DTI, so that's abbreviations. So, let me give you an example of how to calculate debt to income ratio. This is based on $8,000 a month. And so if you have $8,000 a month in income, and then say that you have a $500 car payment, say you have $250 in credit cards, say you have $250 in student loans. So that's your bills equal $1,000 a month if you add all those up. And these are bills on your credit report, okay? If you have other bills that aren't on your credit report, sometimes they aren't calculated in your mortgage debt to income ratio. We're not going to get into all the deviations, but there's a lot. But however, primarily all we focus on is the debts on your credit report. All right, so now let's discuss a mortgage scenario. And so let's just say your estimated payments are $2,000 a month, and that's principal and interest. P&I. And the abbreviation for homeowners insurance, that's also in your homeowners payment, is HOI. So that's homeowners insurance. And so say that's $100 a month. And then say your property taxes are $250 a month. Then if you do a lower down payment loan, you have mortgage insurance, and say that's $125 a month. Then say you live in a community that has an HOA, a homeowners association. That's $100 a month, just for round numbers. You add all that up for your mortgage payment, it's $25.75. And so now you have a front-end debt ratio, okay? You have front-end and back-end. So let's talk about this. So you get mortgage ratio, or your front-end payments to your mortgage payment to your income. So if you take $25.75 divided by 8,000, that gives you 32%. Okay, so your front end, in this scenario, your front end debt to income ratio is 32%. Now, on your back end ratio, this is the most important. That's all your debts, including everything that's associated with the mortgage payment. Okay, and so that's your $1,000 a month in bills, and then your $25.75 for everything in your mortgage payment. Okay, everything's associated with that house. And so if you add up $25.75 mortgage payment plus your $1,000 in bills, you get, $35.75. Now, $35.75 divided by 8,000 in your income, that gives you 44.6%. That really means you're at 45% DTI, debt to income. Okay? In most cases, on conventional loans and some other loans, that's the max debt to income ratio. That's not for every case, but however, just for this scenario, you want to look at that and say, okay, my debt to income's at 45%, the max. I need to try to be under that or at that debt to income ratio if I want to qualify for a house. And so to recap, your bill's $1,000, new mortgage payment $25.75, total bills $35.75. With your $8,000 in income, that gives you 45% debt to income ratio. I hope this helps in the future. And so if you have more questions, contact me at rogersmortgagegroup.com. I would love to help. And if you like this video, please like and subscribe. More to come. Thank you.